So what do you call the combination? So the Fed's assumption is if unemployment's low, inflation gets high. If unemployment goes up, inflation comes down. That's the Fed's assumption. So they actually don't mind if unemployment goes up a little bit because it'll bring inflation down. But what happens when you have high unemployment and high inflation at the same time? The Fed thinks that can't happen. It has happened. It's called stagflation. Stagnant growth with inflation in prices. I lived through it in the late 1970s, early 1980s. I think around the 1979, 1980, unemployment was 10%, but interest rates were 15%. So don't tell me unemployment and interest rates move inversely. Sometimes they do, but sometimes they can both go up together. It's called stagflation, and I see early signs of that. So it's a little bit troubling. But all I can say to our readers and our viewers is Wall Street always gets this wrong. The Fed always gets it wrong. The reason they get it wrong is because their models don't work. Their models are garbage. But the inflation is real. It's going to stick around. But growth seems to be slowing, so we may end up in this kind of stagflationary episode.
Jim Rickards recently sounded the alarm, predicting the U.S. is on the brink of stagflation, a dreaded economic scenario where growth stagnates while inflation remains rampant. If this prediction holds true, the implications could be devastating for a stock market already teetering at unprecedented highs. Investors are riding a wave of optimism, but the undercurrents of economic reality threaten to pull them into a whirlpool of financial turmoil. Stagflation erodes purchasing power, squeezes corporate profits, and leaves policymakers with few viable options. As inflation chips away at real returns and economic growth grinds to a halt, the stock market, currently basking in the glow of record peaks, could face a severe correction. The delicate balance of investor confidence could shatter, triggering a sell-off that would reverberate across the financial landscape. Rickards' warning is a stark reminder that the buoyant market conditions are underpinned by fragile economic fundamentals. The specter of stagflation looms large, casting a shadow over the exuberance of today's market highs, and threatening to usher in a period of painful adjustment for investors unprepared for the dual threat of stagnation and inflation.
And you're right. We've been talking about this in our publications and interviews like this for months or longer. And this was at a time when the Fed was saying inflation is coming down, Wall Street's inflation is coming down, they're going to cut interest rates. The Fed was still saying, we expect 3 interest rate cuts between now and the end of the year. I mean, they were saying this in, the beginning of April, 3 interest rate cuts between now and the end of the year. Everyone thought that there would be no cut at the May meeting. Nobody thought that. But you still had June, July, September, November, December. That's 5 meetings. The Fed's on a crazy schedule. They don't meet every month. It's like every 6 or 7 weeks, but 8 meetings a year is what it boils down to. So there is no meeting in August, no meeting in October. But so you had 5 meetings, June, July, September, November, and December. And you're talking about 3 rate cuts. Okay, no problem. 5 meetings, 3 rate cuts. That seems to work. Except, and this is what we said a while ago, inflation is not coming down. Now, that's the story. That's the narrative. That's what Wall Street likes to talk about because they just want to sell your stocks.
The stock market's relentless surge to all-time highs hinges on the expectation that the Federal Reserve will implement 3 rate cuts this year. Such cuts typically ease business operations and bolster consumer spending, fostering a more dynamic economic environment. However, this optimistic outlook clashes with a stubborn reality. Inflation remains unyielding. Since June of 2023, the Consumer Price Index has lingered between 3 and 3.7%, far above the Fed's 2% target. Despite maintaining interest rates at 5.5%, inflation shows no signs of abating. The persistent inflationary pressure poses a significant dilemma for the Federal Reserve. Cutting rates in an environment where inflation remains high could exacerbate the problem, undermining the Fed's credibility and potentially igniting further price surges. Conversely, maintaining or even increasing rates to combat inflation risks stifling economic growth and investor confidence. This precarious balance underscores the Fed's challenging position. As market euphoria soars on the wings of expected rate cuts, The underlying inflationary woes suggest a rocky path ahead. So the central question remains: will the Fed dare to cut rates in the face of stubborn inflation, risking further economic destabilization?
They stopped hiking rates in July 2023, so that is true. They're just on hold for the time being, but they're not even close to a rate cut, and that's what we've been saying. But Wall Street started talking about this 2 years ago. It was the summer of 2022. Remember, the Fed started raising interest rates in March 2022. At the time, rates were zero. When I say rates, we're talking about the Fed funds target rate. So it's a really short-term overnight rate. We're not talking about 5-year notes and 10-year notes. Those are different. But the overnight rate that the Fed targets, it was zero at the beginning of March 2022. Well, they just started hiking in March 2022. They finished in July 2023. So about 15 months of rate hikes, and they got it up to 5.5%, which is where it is now. But the Wall Street started talking about the pivot in the fall of 2022. Now, they didn't say it was going to be that month, but they said, early 2023, the Fed's going to cut rates. Well, then that turned into like mid-2023, and then it turned into late 2023, and then it turned into early 2024. Here we are in mid-2024, and they were still talking about it.
For the past 2 years, the U.S. stock market has eagerly anticipated a Fed pivot. Since bottoming out in October of 2022, it has enjoyed a steady climb, fueled by expectations of easing monetary policy. Back in November of 2021, with interest rates at zero, the market reached unprecedented highs. Now, in May of 2024, with interest rates at 5.5%, it has surpassed those previous peaks. This relentless upward trajectory, despite a significantly higher risk premium, signals a market driven more by hope than by reality. The discrepancy between the market's expectations and the Fed's actual actions underscores the potential for a sharp correction. Investors seem to disregard the possibility that the Fed, grappling with persistent inflation, may not pivot as anticipated. The market's relentless climb, despite clear signals that inflation remains an issue and interest rates are unlikely to drop soon, creates a precarious situation. This disconnect between market behavior and economic fundamentals makes the case for a sharp correction very compelling. Jim Rickards' warnings resonate strongly in this context. The market's unfounded optimism could lead to a significant downturn if the expected Fed pivot does not materialize. Investors must heed these warnings and prepare for a potential reversal that could catch many off guard.
Inflation peaked in June 2022, 9.1%. And by the way, Matt, let me just do a quick footnote on the definition of inflation. It shouldn't be complicated, but people make it so. When I talk about inflation, I'm talking about the Consumer Price Index, CPI, comes out monthly, computed by the Bureau of Labor Statistics. Consumer Price Index, and it's measured on a year-over-year basis. So you look at the monthly index and you say, what was it a year ago that month? And then that's it. That's how they compute it. Now, that peaked in June 2022 at 9.1%. By the way, the highest since the early 1980s. You got to go back over 40 years to find inflation that bad. But it was 9.1%. By June 2023, so a year later, it had come down to 3%. So, remember after we marched in Baghdad in 2003 that President Bush went to the aircraft carrier and they had that big sign, mission accomplished. Well, the mission was not accomplished yet.
Since the onset of COVID-19, the Federal Reserve massively increased the money supply through stimulus measures. Although the Fed ceased these actions in 2022, the U.S. government has continued to borrow at record rates, causing federal debt to skyrocket from $29.5 trillion in May of 2023 to $34.5 trillion. This $5 trillion increase has had significant implications. After consumers pay their bills and fulfill their needs, this money then ultimately flows into the coffers of banks and large businesses, which then channel it into the stock market. This influx of capital explains the market's remarkable surge. However, this financial environment has left the U.S. consumer stretched to their limits, teetering on the brink of collapse. The echoes of the 2008 financial crisis, triggered by a collapse in subprime mortgages, serve as a stark warning. With consumers grappling with 5.5% interest rates, the pressure mounts. This scenario could lead to increased government funding to support struggling households, perpetuating high inflation and steering the economy towards stagflation. Jim Rickards' warnings about stagflation come into sharp focus here. The continuous flow of government money into the stock market, despite underlying economic strains, creates a facade of prosperity. Yet, if consumer financial stability falters, it could trigger a broader economic crisis. The delicate balance between inflation control and economic growth is at risk, making the current market euphoria a potential precursor to a severe downturn. Investors must remain vigilant and prepare for the possibility that the seemingly unstoppable market rise could end abruptly, with significant consequences for the broader economy. The U.S. stock market may be at an all-time high, but the underlying fundamentals are precarious. Many companies are trading at exorbitant multiples, with stock prices rising even as their revenues decline. This disconnect between stock valuations and economic reality is a clear signal of potential trouble ahead. Jim Rickards' warning should not be dismissed. It is a call for caution. Rather than plunging headfirst into the market, investors would be wise to adopt a more conservative approach. The risk of a significant market correction later in 2024 looms large, especially if anticipated market shifts fail to materialize. Exiting the market now, while prices are high, could be a prudent move to avoid potential losses when the bubble bursts. In this uncertain economic climate, caution is not just advisable, but necessary to protect investments from a potential crash driven by unrealistic market expectations and fragile economic conditions.